The following program is being brought to you on the Voice America Business Channel. For more information about our network and to check our additional show hosts and topics of interest, please visit voiceamericabusiness.com. The Voice America Talk Radio Network is the worldwide leader in live Internet talk radio. Visit voiceamerica.com. The views and ideas expressed on the following program are strictly those of the host or guests and do not necessarily reflect the views and ideas held by the Voice America Talk Radio Network, its staff, and management.
The following radio program is for informational purposes only and is neither specific nor tailored financial advice to any individual. It is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Always do your own due diligence and consult a financial advisor before making any investments. Investing involves risk, which can result in the loss of any or all principal. Peter Weitz is a registered investment advisor with Fusion Analytics Investment Partners, LLC, an SEC-registered investment advisor, as well as a registered rep with Fusion Analytics Securities, LLC, a FINRA registered broker-dealer and SIPC member. All views expressed in this program are those of the host or guests and do not reflect the opinions of Fusion Analytics Investment Partners nor its affiliates. Your investments. How secure are you that they are secure? Do you want to know more about investing, retirement, and moving to the next level in business? Welcome to In Black and Weitz, featuring host Peter Weitz. Our program will answer all of the questions about your future and so much more. It's all about smart business and smarter investing. Now, here is your host, Peter Weitz.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. A lot of thanks to the people that emailed in last week. We got a lot of interesting responses to last week's show, and I really appreciate the support. This week, I'm delighted to have a very special guest with me, and I'm going to introduce him in just a second. But for those that listen to the program know that when we talk about investing, we always talk about protecting your downside. And, you know, I've oftentimes gone into the soliloquy in the beginning of the movie, The Blind Side, that talks about what a right tackle does in protecting the quarterback as he sees the rest of the field without getting hit by a linebacker coming up basically on his blind side. And it's that protection that's really important into the style that we think about when we think about investing. And today's guest is no different. I'm joined today by John Harrington, who is the Senior Vice President of Investments for F Squared Investments just outside of Boston, Massachusetts. And prior to joining F Squared, before that, he is a member, which is cool for us today. He's a member of their investment committee, so he actually gets to decide. He's on the panel that gets to decide what they're actually going to invest in and why. And I think that's important for us and important for you as the listener out there, because you're actually going to get to hear from the person that makes the actual investment decisions on behalf of assets that we as investors would trust John to invest on our behalf. But he's been the director of investments at Rampart Investment Management in Boston, which was a firm focused on enhanced income and protective strategies using derivatives. Prior to that, he co-managed a mid-cap growth portfolio fund at Wellington Management Company, and his career included product management positions at both Wellington and Schroders, as well as portfolio management roles at Munder Capital in Birmingham, Michigan. He began his career in financial services at the consulting firm Rogers, Casey and Associates, where he led the equity manager research division. He got his BA in English from the University of Michigan. We're not going to talk about their football team on this show, John. I'm sorry. And he got his MBA, and he got an MBA in finance from the University of Connecticut in Storrs. And I'd like to welcome John Harrington to the program. Welcome, John.
Thanks, Peter. Great to be here.
And so before I get started, John, I mentioned that, you work for a company called F Squared. We talk a lot on the program about protecting the downside, protecting against loss. And give me a brief overview about the story of F Squared, how the company was formed, and sort of how you fit into that genre.
Yeah, happy to. So our co-founder, Howard Present, spent many years on the traditional side of the asset management business. He had been head of investment product at a couple of big firms here in Boston, Putnam and Evergreen. And it was funny, while he was at those firms, he kind of never understood when the market, let's say the S&P was down 30% or more, if the large cap fund did materially better than that, let's say down 25% in that example. From the manager's standpoint, that would be determined as success. Certainly from the investor's standpoint, it would not be. But the way the compensation programs work at most asset management firms, it's all a relative game. So if you beat the benchmark, you get paid. If you don't beat the benchmark, you don't get as much. But we think at F Squared, it's really more about saving or protecting clients' assets. So F Squared was really founded in 2006. Howard co-founded the firm really along the lines of doing more for the investor, and I think that's where our key product suite is positioned to be able to participate when markets are healthy and protect when markets are down. It's funny. It's such a straightforward value proposition. It's so intuitive, and yet we believe there are not a lot of investment managers, doing it like we are.
And that's, something we talk about all the time, and it makes sense. I mean, who doesn't want to make money when the times are ripe, and no one wants to lose money when they're not. And if you can offer that, it certainly seems like a winning solution, but yet people lose sight of that.
Right.
So be that as it may, and knowing that your philosophy is to protect the downside, if we take a look at where the markets are today, and we're continuing, with the exception of the last couple of days, to hit new market highs. I read a lot of the pundits, and they're talking about a correction. And my two questions to you on that are, number one, what is your position on that? But more importantly, what do you do to prepare for it if you think that's coming?
Yeah, so the first part of it, our position, and I should clarify one thing you said at the outset, which is that I do sit on the investment committee, so that part was right. But we use a quantitative model versus individual input for making investment decisions. So it's really the quantitative engine that determines and evaluates where we are in the market, and then I'll kind of get into how we can. How our portfolio construction rules can be implemented, and we can get more conservative as we get into a more difficult market environment. I can say right now our model is still seeing fairly healthy investment environment. We are still fully invested, meaning we don't have any cash alternatives in the portfolio, but we're starting to see a little bit more risk in the market, and we have kind of a proprietary measurements that provide that. So we're seeing a little bit more risk, but we haven't kind of pulled the plug at all in terms of the actual portfolio constituents. So as I said, we're still fully invested. But it's interesting, as you point out, I think September 18th, we hit a new high since the market correction back in 2000 and, the bottom in 2009. So now, we're 6 years really into this, or almost 6 years into this recovery, which when you look back historically is a fairly, bull markets are anywhere really from 4 years plus. But certainly getting close to 6 years, we would argue is, in if not late stages, maybe the latter stages of a bull market. We know we've had 10, 20% corrections since 1950, so we know the market moves in cycles, and I think that's why we manage the money the way we do. I think the second part of your question for what can you do, what we do to be prepared is we use our quantitative engine to evaluate and scope out what risk is out there in the marketplace. And when that risk exceeds certain levels, we think it's a better move to get out of harm's way, and we do it at a sector-by-sector basis. So if you think about utilities, consumer discretionary, healthcare, the various sectors, our model will look at each of those sectors, and assuming things are all a go or fairly benign in terms of the risk, we'll stay invested. But once the model determines that there's too much risk in that sector, we'll get out of that sector and move first to other sectors, and then if enough sectors go negative, we can get, as I said, to a cash equivalent position. So the nice thing about kind of our approach, from my perspective, is it's very systematic and really automated. We're not again sitting around a table making prognostications about where we think the market is going. I think you can look at any CNBC program or pull up any of the market pundits, and exactly as you said, some people are saying we're going to get another 10% move up. Some people are saying the correction is near. Small caps, just to throw that out, we're already seeing a corrective phase where they're down more than 10% since their high. So we would argue there's a little bit, and certainly personally I feel that there's a little bit more risk in this market than there was, say, a year ago.
And I think, you and I have had several conversations in the past about this, and one of the things that about your model that appeals to me is your ability to really be agile in the markets. And comment for me briefly about how often you actually review your model and how often you can actually make changes to it.
Yeah, so we run the model on a weekly basis, and we use volatility as our primary driver. We can go long periods where we don't make any change to the portfolio. So we don't like to. We won't make a change for change's sake, but we can and have made pretty radical changes over a 1 or 2 week period. Back in the middle of 2011, for example, 2011 is a good example. The first 7 months of that year, we were either 8 or 9, so there's a total of 9 sectors. We were either 8 or 9 sectors on, and then in August, we turned financials off early in August, and then we turned 5 additional sectors off the following week. So when things change, and as I think your listeners know, they can sometimes change fairly dramatically, we have that, lever to pull in the portfolio that can get the clients ultimately, the dollars first, and ultimately their participants or clients' assets out of the way. So to answer your question, it sometimes we have very significant turnover, and sometimes there's very little.
Yeah, and I think that aligns, well with the philosophy of this particular show because of my program. Because we've made the argument more times than not that there really is almost 2 asset classes: what's working and cash. And it appears to me that your model basically it's very simplistic. And I don't mean to make it appear that it's a simple model. It's very complicated in the way you've developed it, but it's very simple: is that you either are invested or you're not.
Yeah. No, I think and I like those 2 asset classes, what's working and what's not. It's interesting because some of our competitors have a different way. If equities aren't working, they'll go into, say, longer duration or longer term fixed income. You're absolutely correct. Our choices are it's either working or it's not. And if it's not, we move to an asset that we know does not correlate with some of those more risky assets, and that is cash alternatives. So we don't, people ask us if we're allocators, do we make the decision, well, now this asset class is more attractive than this asset class. We really don't do that, even in our balance strategies and in our target risk portfolios, which we'll probably talk about on this show, where we have 4 different asset classes. We don't really make tactical shifts among them. What we do is evaluate, is each of those sleeves or asset class, fixed income, international equity, U.S. equity, real assets in the case of our target risk, is each class still healthy and still likely to advance, then we will stay invested in them. If not, we have the opportunity to go to cash equivalents.
Yeah, and I think that is really what tells a story. And we've described it in the past, and you've described it to us, is that essentially you think of the way you invest like a lever, like a toggle switch, on, off, on, off. And if you're looking at 9 different sectors, each one of those sectors, the switch is either going to be on or it's going to be off.
That's right.
And
That's
that
exactly
makes
right.
Yeah, and so for me as an advisor, it's a great story to tell an investor because it's very easy to explain.
We do get that comment. It's our portfolio construction rules are also fairly straightforward. We do exactly what you say. We use volatility to evaluate each of the sectors. Then we look for a confirming signal to see if that sector should go off. If that sector does go off, as I said, we go into the other sectors. From a portfolio construction standpoint, when we get to 6 sectors out of 9 off, which is, 2/3 of the market, if they're all off, that's telling us something about the market environment in general. And that's where we would start to go to cash equivalents. Or cash alternatives, I should say. The other nuance or limitation there is we have a maximum in any one sector of 25%. So if we have 3 sectors, that's obviously 75%, and the balance of 25% goes into a cash alternative. So I think from the client standpoint, they really like the fact that they have a manager who, they don't have to sit there and, read the financial press or ask their advisor to, make a determination of is the equity market too frothy now. We're doing that kind of behind the scenes in a very systematic, automated, and we would argue time-tested, with the quick caveat that, past performance is not indicative of future results, as I'm sure you say it many times in the program.
It comes up in all our disclaimers, and our guests are about to listen to one in just a moment. John, we're going to take a quick break. When we get back, I want to talk a little bit about how your strategies work in retirement programs. And we're going to do that in just a minute. You're listening to the In Black and Weitz radio program on Voice America Business. Be right back.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. I'm joined today by John Harrington, Senior Vice President of Investments at F Squared. And we spent the first segment talking about the strategies that they've designed as a sophisticated money manager to help protect downside and help protect against risk when we're investing. And I think that strategy really works well in retirement plans. And for those of you that are regular listeners of the show, you know that a vast portion of my business practice is in the retirement and the 401k space. And F Squared certainly makes a statement with regards to the way they manage in a 401k plan versus the typical investment options that you normally see. And John, I'd like to just spend a few minutes talking about your strategies and how they really work well in a plan. And I want to you really focus on the drawdown in the market. So if there's a really big pullback or a correction, where those strategies excel.
Great. Yeah, I'm happy to talk about that. So we have a number of different strategies that we offer on retirement platforms. You can get either our legacy equity strategy, fixed income, or we have a series of target risk strategies as well, which have, I think I mentioned earlier, 4 different asset sleeves within them. It's interesting, if I can just step back for a minute and talk about your listeners or plan participants. We think this is really a challenging area for a lot of participants because here they are, they're in other businesses and pursuits, they could be in advertising, car sales, whatever it is, and they're thrown this roster of funds in their 401k. Hopefully some have good advisors, but many don't, and they have to make a selection really based on limited financial knowledge. And, of course, it's a critical decision to make because how they invest over the next 20 or 30 years will really drive the quality of life or certainly their financial security as they go into their retirement years. So when we talk about protection, we talk a lot about avoiding maximum drawdowns or significant drawdowns. And let me just define that for your audience. If you look at a 5-year track record of any investment product, and you look at if you had gotten in at the very peak of that, and had gotten out at the very trough, so the low point, what would your return have been? So it's kind of the worst performance. In S&P 500 terms, if you had invested back in November of 2007, let's say you invested, $10,000 in November of 2007, and by March of 2009, you had just about enough of the equity market. Your $10,000 would be worth a little less than $5,000. So there was a 51% drawdown. And one of the interesting things about the geometry of returns or the linking of returns is when you're down 50%, being up 50% only gets you back to halfway to where you were. So because you have a lower base. So that may not be intuitive to all of your listeners, but if you're down 50%, you have to be up 100% to get back to square one. 100% can be many years in equity market returns. So moving to our product suite, that's exactly why we implement our strategies the way we've touched on, which is to, evaluate the type of environment that we're in, de-risk out of those sectors that appear to be too risky, move to cash equivalents or cash alternatives if too many of those sectors get negative, and therefore the environment itself is negative. And by doing that, we can mitigate, not eliminate, but we can mitigate drawdowns. So, we don't put out, expected percentages that we would want to be down. If the market's down 20, we wouldn't want to be down more than X. But the strategy, the design of the products are to do exactly that. And what's important is they do it in each of the 4 asset classes within our target risk portfolios. So in each of those asset classes, we're thinking about the risk side more than the upside participation. And we hope to, and the products are designed to, take those client assets and move them to higher ground, if you will, if we get into that type of difficult market environment. So I think that's why clients, like the strategies certainly in the retirement space.
Yeah, and I'd agree with that. Now, a couple of weeks ago, and John, I'm going to do this sort of in broad strokes. I don't have the exact figures in front of me, but a couple of weeks ago, I was talking about retirement plans, and I was talking about, mitigating risk just as you are today. And I was saying if you invested just statically in the S&P 500 20 years ago, 100,000, and you rode the market for 20 years, it'd be worth 150,000 or some odd dollars today. Okay, if you captured the 10 best days of the S&P 500 over that period, that actual 100,000 would grow to 300,000. Roughly in there. I'm not, and I don't want to. My numbers aren't going to be exact. But the point is this: is that if you missed the 10 worst days in the market, that 100 grand grew to 600 grand. And the point is that, aligning my thinking with what you're saying is that by mitigating that drawdown risk, by not capturing the 10 worst days of the S&P 500, you're actually making your clients more money in the long run.
Yeah, we would totally concur. To be clear and to be a little careful, because it's important to understand our strategy. You're absolutely right. Our attempt is to miss those or avoid those bottom 10 days. As some of your listeners may guess, when you do that and you de-risk, there's going to be up days that you miss. So we never, we're very clear about we miss some of those best days, and hopefully we miss most of the down days. But when you do that, that geometric point that I made earlier, that linking of returns, if you can really get that big drawdown out of the way, or at least mitigate it, you don't need to be there for all of those up days. So it's important to know that there's our models certainly work. They work through different market phases. They're going to be, a little bit. It's going to take a little bit of time to get reinvested as the market comes back. So we're going to maybe lag a little bit on the way back in. But the point is, if we protect it on the way down, that's going to serve the client well. The other thing I'll just say very quickly is, which we don't really talk about, the behavioral finance part of this. But when you think about it, think about the distraction and the angst that those big drawdowns cause people. Target. Where did I read? The average target date fund 2010 was down something like 30%. If you can mitigate that, you can reassure investors that the equity market, while it is there can be risk in the environment. If you can mitigate that risk, they will stay the course. And staying the course is a big deal because, as we all know, it's those investors that if you bailed, in my earlier example, in 2009, you would have missed a 200% plus recovery since the bottom. So we don't want people, we want your investors or your clients, your advisors, clients and your listeners to all, if they've decided that a certain portion of equity should be, or a certain part of their portfolio should be invested, we don't want them to give up on the equity market, but we want to offer tools to help mitigate or navigate, if you will, those phases that are particularly challenging.
Well, and as a professional, as industry, John, I would certainly agree with that. I mean, I would much rather miss some of the upside than not have to take the pain of the downside. And just to make, what you've said, your examples earlier about mathematics even clearer. I mean, if I gave you $1 and you bought and you lost 10%, you now have 90 cents. Well, to get back to $1, you can't make 10% because you don't have 99. So you make 11, so you have to make basically 11%. Well, I would much rather be in a position where I lose 10% and only have to make 11 back to get back to where I was than have to dig out of a hole where I'm down 51% at the trough of the S&P 500 in 2009, having to make 104 to get back to even. And so if you actually the risk of the people that took that 51% hit, the risks that they have to take just to get back to even are unbelievably high compared to what you have to do to get back to even and then start to grow the portfolio again.
That's right. Absolutely right. And you think about those people that, when they get their statement, they open their statement, the difference in reaction if they're up a little or down a little even those two, not even a lot, right? I mean, it gets back to the premise of our firm, which is people don't want to lose money. They love to make money. They love to go from, 10,000 to 15,000, but don't take what I gave you and reduce it. And I think that really, we have kind of we have a different response to that as people. We don't like to lose. And I think that's really what we've keyed into, hopefully in a very disciplined and strategic, really, way.
Yeah, and I couldn't agree more. I mean, I think it's that and what I like about the strategies are that there's, and as you mentioned, and as I was saying, you're on the investment committee, but yet there's a mathematical model that determines, when you're on and when you're off, and that takes out that whole premise of, quote, I think. And when I listen to the average investor out there, they think the stock is going to go up or they think the market's going to go down, and that's what they base their decisions on. But when you use statistics and math, all that opinion and conjecture is taken out of the way. Right,
absolutely right. And I say this all the time, but they're using clients' money to essentially support their own, not support, but they're taking their opinion of a stock or where the market's going, and they're taking client money and investing it that way. They may be right, but they may not be right. And we're, of course, not always right either, but we have a very what I like about our strategy is, I've talked about it using volatility. I haven't, probably your listeners are happy I haven't done this, but there's a lot of research out there that shows that volatility can be very, very predictive, and it's really why we use it, because it tends to cluster. It's a lot different than performance. But when you get into a volatile market, that's when you tend to get these extremes. And if we can step aside in some of those markets, that's going to benefit the client. And it doesn't matter. Our quantitative engine is totally indifferent as to what's causing the volatility. So it can be upheaval in Europe. It can be what Janet Yellen is doing at the Fed. It can be anything. And it will react because prices react when there is risk.
Yeah, and you're able, and obviously, as we mentioned earlier, doing that on a weekly basis is going to keep you as agile and as nimble as necessary to be able to make sure that you're on the right place. You're in the right place in the market at the right time.
Correct.
Yeah, and we're going to take a quick break, John. When we get back, I want to talk a little bit about how you actually measure volatility. And what that actually means to you, because it's a term that's thrown out, all the time. But yet, I really want to get your opinion of what you really think that means. And we're going to do that in just a minute. You're listening to the In Black and Weitz radio program on Voice America Business. We'll be right back.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
What are your business goals? How do you plan to accomplish them? Your strategy for business growth matters, and the experienced corporate lawyers at Retzel will collaborate with you to develop and execute a customized plan designed to unlock value at your enterprise. Whether the growth you seek is domestic or international, organic or driven by acquisitions, our attorneys are here to propose innovative solutions and assist you every step of the way. For more information, visit us at www.ralaw.com.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com. You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. I am joined today by Senior Vice President of Investments at F Squared, John Harrington. And John's been spending, John and I have been talking for the vast majority of the show about how to protect the downside, how to protect your investments from losing money. And I think it's an outstanding value proposition that F Squared Investments has put together. And their general premise is we don't want our clients to lose money, or we want to do the best we can to prevent our clients from losing money, because that's certainly a much nicer and easier conversation to have than when the markets go down like they did in 08 and 09. And one of the comments that John made is that they focus on downside risk management by measuring volatility. And prior to the break, I asked John if we could spend a couple minutes talking about that. And John, I really want to understand sort of what volatility really means from a professional like yourself in the industry to the average investor, and what you think about that might be different than something, the average investor would think about with regards to that volatility.
Yeah, great. Well, it's a very appropriate question for F Squared, because we are, I think, at the forefront of some of the work we're doing, or we're at the forefront of the field in terms of what we're doing in volatility research and evaluation. And we have a whole quantitative team with PhDs. I'm certainly not one of them, that evaluates volatility, different ways to look at it, different ways to measure it. How do we sort out the noise from what we really want to count and what we won't really want to measure? And maybe, an example that I use, I think that's somewhat helpful to just contrast what we do versus what others may do. If some of your listeners are familiar with the concept, rather, of standard deviation, which is just, it gives a variance around a normal. You put in a lot of observations, you create a distribution, and you come up with standard deviation around that mean or that average. When you look at it in the market periods, if I said to you, I'm looking at a 12-month standard deviation number, let's call that number 20%. Well, when you think about the way standard deviation is calculated, that 20% is driven by the average of those 12 months variance or deviation. So it would count, let's just use a calendar year. January in the year would count as much as December in that year. But what if I told you that the first 11 months the volatility was 10, and the 12th month the volatility was 30? So, and by the way, now we're in January of the following year. We think that December observation of 30 is certainly relevant to where the market is. So we think the average of 20, and don't challenge me on these averages, I just kind of picked them out, but I think hopefully the point is clear that a simple average of those 12 months may or may not be a good indicator of where we are. So what do? We look at a lot of different time frames. So if it's when we run the model, we look at volatility over not an infinite number of periods, but almost an infinite. We look at, 1-day volatility, 2-day volatility, 4-day, 8-day, keep extending it, 2 months. And I say we look at it, I mean we look at the current volatility level relative to those like periods over the last few years. So we look at 2 weeks versus 2 weeks, 4 weeks versus 4 weeks, going all the way back a few years. And what we get, Peter, is an idea as to whether are we in kind of a new volatility regime? Is there a statistical significance to this move? Let's say the 2-week volatility is higher than any 2-week period we've seen in the last 4 years. What we do with this is then we have some confirming factors, one of which is price trend. But once we have that and we can turn the sector off, as we talked about earlier, we believe, and certainly the model is designed to react much more quickly to an oncoming storm. So we believe that by having what we would call a dynamic, modulator, right? You're able to look at 2 days. Maybe the 2-day volatility doesn't look so bad, but now we're at a 2-week elevated level relative to all 2-week periods. You know what? We think it's time, to move that sector to the sidelines. That's going to be, we believe, and we think, when you look at our long-term performance, we think that supports it, that we're able to move, fairly quickly to get out of harm's way. And just to finish, and also can reengage and get back into the market or into a sector the same way, because we're able to kind of just pick up nuances and inflections in the market that I think something like standard deviation, which is more of a smoothing, longer-term metric, we think does not do.
Yeah, and I think that point deserves to be made again, John, is that your point is well taken, that if you just average standard deviation over a 12-month period, one period of volatility versus another gets the same weighting, and that may not be representative of really what's going on from a risk perspective in the market in the current moment.
Right.
And so your method of looking at it from different time perspectives, I think, is a great way to determine really where the volatility is coming from.
Yeah, No, I would agree, and as I said, I'm not one of the resident mathematicians down, with our quant team, but I can tell you that they look at some, very sophisticated volatility patterns and ways to measure it. One of the big things they do is try to isolate, as I said earlier, the noise from the signal. So there's with volatility, you get, and I won't go into all the mathematical details, but I think you can guess if you have some volatility, there's going to be some of that may be relevant, and some of it may be not as relevant. One of our filtering devices actually can isolate it and determine, or the intent is to determine where it is in fact statistically significant. To digress for a second, if one comparison is to facial recognition software, and your listeners are now wondering where I'm going with this, but if you think about facial recognition software, it will look at 10 people and it will pick up common features like a nose, two eyes, lips, and there's this commonality, but then there's these nuances of differences, right? Somebody's eyebrows are darker, somebody's cheeks are more round, and that's how it starts to isolate these differences. That's very similar to what we're doing with volatility. We're looking at kind of broad level volatility, like facial recognition. Then we sort through in these various filtering mechanisms and get down to whether it's really a meaningful volatility observation or not. I hope that was clear.
No, that's a great example. And I think what's even more interesting for my listeners, John, is that they're getting insight into the way investment decisions are made on the more sophisticated mathematical statistical level. So, yeah, your examples, bring it down to a really simplistic sense, but yet there's so much more intricacies to it, but yet they're able to understand really what's going on. And I appreciate that example. It makes a lot of sense.
Okay.
My next comment is, so, again, I focus a lot on the retirement space, and I think I saw a statistic that said that roughly 80 cents of every dollar lately is going into target date funds. I'm going to call them the soup du jour, if you will, inside of a retirement plan. And I guess it makes a lot of sense because, the plans that I see, the typical worker in a company really doesn't follow the investment markets in any way whatsoever. And so it would make sense for them to go into a diversified portfolio of investments that they don't have to watch on a regular basis. But in listening to your conversation or listening to your comments today, it almost even seems that they're going to get even more professionally managed accounts that are risk, centric based upon that particular client's level of risk by considering one of your sector strategies as well.
Yeah, so I think that's correct. So if you think about a target date fund, and you're absolutely right, we see a lot of dollars going into those. What they do is essentially, step down your exposure to the equity market from the time you're 25 to 65. So you're going to retire in 2050, and we're going to have a lot of equity exposure because you've got that long a time to kind of live with the ups and downs of the market. And by the time you get to 2045, we're going to put you more into fixed income, this notion that's called a glide path of automatically adjusting your allocations based on your aging, essentially, and your movement towards retirement. But when you think about that model, and then you think about what we do. So we have target risk strategies. So we don't call them target date because we don't have automatic step downs. We do have aggressive with 80% equity and conservative with 40%. So we do have different mixes. But then what I really like about them and why I think why I love talking about them is because on one hand, they're lining up the risk of the portfolio with the participant. So you're a 25-year-old worker at a retail store, you're going to get 80% equity exposure. But then let's suppose in 6 months from now, we get into a market correction. And let's suppose there's that 25-year-old worker with 80% equity, and there's a 65-year-old worker with 40% equity. F squared is going to automatically and systematically adjust the equity exposure in those two portfolios based on the market environment. So it's like a second level of risk control. One is just age-driven and, risk profile driven. The second is, well, what's the market look like? What's the environment look like? And I think it makes a lot of sense, because if the market's going down 20%, does the 25-year-old have any more interest in living through that just because he has less money or she has less money saved? I don't think so. So I think it's a very, and again, you talked about simplistic earlier. I don't mind that word at all, because the target date funds that have been, garnering a lot of assets, this automatic step down and putting 65-year-olds into, 80% fixed income or 75% fixed income. And I know we don't have time today, but that's a whole other discussion about whether fixed income right now is a very conservative asset class. After a nice 30-year bull run, we're certainly not so sure. So I think the folks that have invested in our target risk strategies get kind of that double level. They get the appropriate level of risk for themselves at their stage in life and their risk profile, and then they get F squared kind of under the hood, automatically driving the allocation depending on market environment.
Yeah, and I'm going to agree with you, John, that we've mentioned on this show in the past recently that we don't believe we're really cautious in the fixed income market as well. So I'll concur with you in that. I got one quick last question because then I got to wrap it up, and I really appreciate being on the program. But going back to your model, going back to your strategy of this alpha sector strategy, the strategy used inside of the 401k plans in particular, you mentioned that a 25-year-old could be 80% invested, but at that same time, 80% invested in the stock market, I should say. But if you feel in your measures of volatility that 80% exposure in the equity markets poses some level of risk, you can dial that down with your levers, just as you would, as you explained in the beginning of the show, correct?
That's correct. So yeah, and maybe I didn't close the loop there, but so what I meant to say is that 25-year-old or that 65-year-old could theoretically have the same 100% cash equivalents or cash alternatives in their equity sleeve. So even though one sleeve is, 80% and one is 30, they're not going to have any equity because we think the market is potentially too risky.
Yeah, and that is, to me, what speaks volume about your program, because you're basically saying that I'm a 25-year-old, I can take 80% of my exposure in my 401k plan, put it into the equity markets, and I can know that it's going to be risk managed if something happens, so I don't have to worry about that 51% drawdown like the S&P had from that period of 07 to 09.
Right. I mean, I would always say, with compliance folks, you can't say I would never have to worry about it, but the product's design is to mitigate that, absolutely.
And I appreciate you correcting me on that, John. I would never want to say that. But I really appreciate you being on the program, John. I mean, we could go on and on for hours about this because it's such an interesting strategy that F Squared Investments has put together, and I really can't thank you enough.
Well, I'm happy to be a guest and look forward to talking to you again, Peter.
Great, thanks. We'll be back with F Squared, and I can promise you very soon in the future. But thank you again, John Harrington, for being on the program. You've been listening to the In Black and Weitz radio program on Voice America Business. Make it a great week.
Thank you again for tuning in to In Black and Weitz. Please join your host, Peter Weitz, again next Tuesday at 10 a.m. Eastern Time and 7 a.m. Pacific Time for another edition of the program on the Voice America Business Channel. Have a safe week.
Thanks again for listening to the preceding program, brought to you on the Voice America Business Channel. For more information about our network and to check out additional show hosts and topics of interest, please visit voiceamericabusiness.com. The Voice America Talk Radio Network is the worldwide leader in live Internet talk radio. Visit voiceamerica.com. The views and ideas expressed on the preceding program are strictly those of the host or guests and do not necessarily reflect the views and ideas held by the Voice America Talk Radio Network, its staff, and